Hey everyone, this is Kirk here again at OptionAlpha.com. Hopefully, everyone had a great long weekend. In case you guys didn't hear the good news via Twitter, Facebook, etc., my wife had our beautiful baby daughter on Saturday, so it's been a whirlwind, definitely for sure, and just getting back into the swing of things here a little bit. And I'm sure I'm going to have many, many sleepless nights. So, lots of updates coming out probably in the evenings when baby is sleeping. But baby and mama are great and just going to keep moving forward. Thank you guys for all your support as always. So let's talk about the opening and closing trades that we have for today. Today was actually a pretty active day with the market selling off as much as it did, and hopefully crossing our fingers. It's going to continue a little bit more so that we get that nice kick up in volatility that we started to see. But as far as trades that we closed out today, there were two trades we closed out. One was a Bank of America vertical put spread that we closed out. Nice little profit. Again, it's December expiration here, so you can see it was the 1714, so it was about $3 wide. And that very nice wide spread. And we closed out for 160. Not a huge profit on it overall, but $32 per contract, so we made about $90, a little over $90 on this. The other one that we closed out today, and actually one of the few losses that we've had recently, is just a December DIA puts. And even though we closed them out for 24, the DIA put spread is still a little bit far out of the money from where the diamonds are right now. And if we just continue to get a little bit sell off, there might be something left here, but we figured, you know what, take the money off the table. It was a $73 loss per contract, so a little bit bigger loss and wider loss. But again, that's what we need to do here is manage winners and losers, take some off, keep that $23 per contract on as some of, I guess, a little bit of savings that we didn't have to go blow through. As far as opening trades, and then we'll kind of go over the charts of all these, it's pretty simple what we did today. The first, or the bottom two here, the vertical put spread on FXE and Groupon, GRPN. Very easy, very simple trades. All we did with these is buy the front put, which is the 137, sold the 136. For Groupon, we bought the 11 and sold the 9. So you can see these are $1 wide here on FXE and just over $2 wide on the Groupon. And that's reflected again on all of these vertical spreads that we do where we're actually buying and buying them as a debit to open rather than a credit to open. What we actually want to do is target somewhere around 50% of the width of the strikes. So in this case, this FXE put spread is $1 wide or 1. So our target was right around 0.5 for a price, and we got 0.52. So not too bad. Same thing with Groupon. Groupon was about $2 wide, and that would mean our target is about $1, and we got 99 cents. So a little bit better here, a little bit worse than expected here. Again, it all is going to average out, but you don't want to be paying 105 or 110 for this type of call spread or put spread, I'm sorry. And same thing up here for FXE. If you're looking for a premium around half the width of the strikes, you don't want to be paying 60 or 70. That's just doesn't make sense as far as the probability that you're taking on. It's only a 50-50 shot. And so you'll look at the charts when we get into that later on why we made these trades, because both of these are trading so much higher that we're just taking a probability trade that at some point between now and January expiration, which you can see here, the January expiration options, that both these FXE and Groupon are going to trade lower at some point, and we'll have an opportunity to take a profit. Really, it's exactly what we did here on Bank of America. Our whole premise on Bank of America was that we wanted to take a profit at some point between now and December expiration when Bank of America traded lower, which it did. So that's what we did, is close out for a nice little profit. The last trade I want to talk about here on opening trades before we go to the charts is a look at the vertical spread in Dow, and that's not the Dow Jones. This is Dow Chemical. DOW is the ticker symbol, DOW. And in this case, we sold the 42 calls and bought the 43 calls, a little bit different. And we took in a nice credit because, again, we're selling premium to begin with. We took in a nice credit of 33 cents. So this is actually a nice trade. It's about a 70% chance that it's going to be a winner based on where the probabilities are for Dow. And you'll see when we get to the chart that implied volatility is much, much higher for Dow right now than it has been in the past. So that's why we want to make these types of trades, because implied volatility is so much higher. So let's go over to the charts. Let's look at DIA and Bank of America, and then we'll get into the other ones. So here's a look at DIA. Again, Same thing here with the diamonds. It had a nice move down. We take some money off the table, but our strikes were down here at 157 and 155. So still a pretty substantial move in the next 10 days. If we get there, great, and it is what it is, but I don't think we're going to get there. I want to take some money off the table and just keep moving on. Same thing, Bank of America. Bank of America, we had a vertical put spread on, so all our bet was that Bank of America would trade down at some point, and you can see it did. And so when you have these days where you're making a 50-50 bet and the stock moves where you think it's going to move, you've got to take the trade off, make that lock in that profit and take the money off the table. And that's exactly what we did. You can see that Bank of America's implied volatility percentile is back up a little bit. So we might be looking into some vertical put spreads that we're selling for a credit now instead of buying in the next couple days here. So we'll see if Bank of America starts to decay just a little bit more in pricing. Let's go over to FXE. So this is the Euro Trust. Again, this is a pretty clear explanation of why we made this trade. You can see how much the euro has moved up in the last month and a half, and it's almost gone parabolic in nature. So because of that parabolic move, this is when you take those trades. Again, low volatility, it's only 21 percentile, so it's not over that magic 50 number. And you make a bet that at some point between now and January expiration, which is way out here, that at some point it's going to trade lower below right where it is right now. And that's all we're doing, is making a bet that at some point between now and January it will trade lower, and we'll take the money off the table and exit the trade. Same thing with Groupon. Groupon's a very similar story, just it has a more quicker pop over the last couple of days, and this trade's actually making a little bit of money already right now. But you can see Groupon had a nice little pop up. It's moved a little over 15% in the last couple of days, so huge move in Groupon. So we bought the 11s and sold the 9s here. So we want Groupon just to trade anywhere, right kind of in this middle range, right around 10. It's got to just trade a little under 10 and we'll make some good money. So I think it might do that. You can see that Groupon historically has had a couple ups and downs where it has these pops and drops in the security price. So again, we're just playing this market cyclicality that the market's going to reverse. People are going to take profits off of this type of move. They're going to lock in that 15% gain if they got in anywhere down here, and Groupon will start heading lower here between now and January expiration. All right, so final trade of the day. This was Dow Chemical. Dow Chemical is an interesting trade because of the volatility. It's up in the 90th percentile up here, so if you can see that, it says 92. You might have to enlarge your screen. Again, all these videos are done in HD, so you will be able to see it. But it's in the 92nd percentile. And so what that means is volatility is historically now higher than it usually is 92% of the time. And so what that means for traders like us is that we want to make trades that take advantage of this high volatility. And those types of strategies are things like iron condors, strangles, credit spreads. We don't want to be trading any type of vertical spread, whether it's call spreads or put spreads, any type of debit spread. We don't want to be doing any of that stuff. We don't want to do calendars that takes advantage of a rise in volatility. That's not what we're here to do. So with implied volatility this high, this is when we need to take advantage of where the stock is currently and make a nice implied volatility trade, sell some premium, and hope that the stock either goes down or implied volatility goes down. So in this case, what we did is we sold the call spreads above the market, so we're up here above the market, only because our underlying assumption is that, okay, it's had a nice pop in the last couple of days, so it should at some point start to go lower, which will just help our premium decay. I could have easily sold a put spread below here if you thought, hey, you know what, I think with this pop, Dow Chemical could continue to go higher. So it doesn't matter which direction you go, as long as you're trading the same probability. It has the same likelihood of hitting both levels right now. But right now, I think that with this pop, it could go down just a little bit as people start to take profit off the table. So that's my underlying assumption. Again, it doesn't matter which direction you're going. We sold the call spread. You could easily sell the put spread. Same probability level, take in about the same premium, and make that directional trade. But the key with everything on this particular trade is that we sold the credit spread when implied volatility was high, not when it's low. And if you take that away from it just alone, regardless of market direction, you'll be a little bit better off going forward. So hopefully that really helps out today with the video trading alert. As always, if you have any questions or comments, please share them right below here. We'll get to all your questions or comments about this video. Happy trading.